Alright, Happy New Year! And as part of the first video back in 2018, I thought I would cover a highly relevant topic to 2018, the charts to watch for this year. So this article here is just it's an excerpt from this report here, the 2017 end of year special edition. So if we jump into that, so you can download that report. I'm actually making this available as a one-off free download, bit of a happy holidays treat. So you can just click that download link there. And note if this is actually the end of year special edition of the weekly macro theme series. So this is a weekly report. It forms a key part of the service that we provide to institutional subscribers. The other part is the monthly chart book. So if you wanted to learn about that, then you can just click through there. But look, what I wanted to do is just go through and add a little bit of extra context to each of the charts because really have only added a one line sort of thing in this one here. So we'll start off with this one. And really I think that this is one of the key charts to be looking at in 2018. It shows you the amount of spare capacity for developed economies. So this is aggregated across America, Eurozone, Japan and the UK, so the major developed economies. In the black line, it's industrial capacity utilization, and you can see there that that's actually gone up. This is the Z-score of that measure, so it's gone up to basically back to normal. And this is after, what you could probably describe as considerable period of spare capacity. And the same thing on the unemployment rate, so it's actually inverted to line up with that. So this is the composite unemployment rate there showing inverted, and what that shows you there is that it's actually the labour market across the developed economies is looking as tight as it was at the top of the last cycle. So what this shows you really is a maturing of the cycle, a tightening up of capacity, and it also helps explain the whole sort of mystery of the missing inflation because running this massive and prolonged period of spare capacity, ever since the crisis, obviously you're not going to have much inflationary pressures doing in that sort of environment. Of course, now that the story has changed there, inflation should only be a matter of time. The second one, kind of related I suppose, is generally across time there's been this tendency for US 10-year bond yields to line up with US 10-year GDP growth, or sort of longer term smooth GDP growth in America. And you can see there that, based on the IMF forecasts and, actually based on, a number of good reasons, it looks like that longer term pace of GDP growth is bottoming out and is set to turn upwards. And if you call this a sort of a medium-term view on bond yields, it kind of lines up with the shorter-term cyclical view, which we've been talking about in terms of the improving macro data in America and across developed economies. So, it's been one of those enduring forecasts of a lot of economists that bond yields are going to rise. But I'd say that, more than any time of the last couple of years is probably the scene is set for this to happen. So, really two key charts there. This number 3 is about the monetary policy tides going out, and one area that can actually impact on is gold. So you see here in the blue line, the light blue line, that's the shadow Fed funds rate, and that really just attempts to factor in the impact of quantitative easing on the effective level of the Fed funds rate. So when quantitative easing was, at its most intense, that back in around 2011, 2012, you had a Fed funds rate, note that it's inverted here as well, was, pretty deep in the negatives, around -5%. So, while the actual was sitting at 0, the effective was sitting, much lower than that when you factor in the impact of QE. Now you've actually had QE going the other way. You've got quantitative tightening. Not fully into tightening mode yet because they're still reinvesting some principal, but they're reinvesting at a slower pace, so they're sort of tapering or tightening that off. And of course, the Fed funds rate itself is rising. So, you know, all else equal, should the Fed funds rate continue to rise, should quantitative tightening continue as planned, that's going to present headwinds to gold, all else equal. Number 4, emerging markets. I found this one really quite interesting chart. In the red line, it's a composite of risk pricing. So this is emerging market corporate credit spreads, emerging market implied equity implied volatility, CDS pricing, and I think that's it. Yeah, so a pretty broad view or comprehensive view of risk pricing across government bonds, corporate bonds, equity. So it gives you quite a holistic view of risk sentiment in emerging markets, and you can see there that because it's inverted, very relaxed levels, and this tends to get reinforced by the improvement in the economics. Of course, that also, calmer risk pricing is also something that helps economic conditions, but you can see there that the two are sort of intertwined, and for now there's a virtuous cycle going on there. I would say that the time of most risk is not when risk pricing is spiking. It's actually usually the opposite, when risk pricing is very complacent. So this is one, it's both good and I don't know if you call it bad, but certainly when you're at these kinds of level, it's harder to get much better than that. Number 5, kind of a similar topic here. This is looking at US high yield credit spreads, which are in the red line, and it's comparing that against the economic cycle indicator here, which are using the manufacturing PMI and jobless claims. And the reason why you want to look at the economic cycle is that that it lines up pretty well with what's happening in credit spreads, and there's a good reason for that. If the economy is doing poorly, if it's deteriorating, then that's going to make it hard for companies to pay their debts. It's going to make the risk of default and bankruptcy higher. So of course, risk pricing should reflect that. And if economic conditions are good, then the need for a risk premium short term is arguably lower. Now, there's a lot of things that we can say about corporate credit spreads, about the overall conditions, but as a sort of a timing indicator, this one's quite useful because where credit spreads are right now, you could call that overvalued, and that the credit risk premium is not giving you that much compensation for taking on credit risk. But you could have said the same thing in the mid-2000s there, and for quite a long period they did nothing. It was only till that you got a real major divergence between the economic indicator and when it really started to turn down that it started to actually flag a more meaningful warning signal. At this point, it's pretty good. It's about as good as it gets. Kind of justifies the current level, if not arguing perhaps that they should even be lower. But of course, when it does get this good, the risk is that it starts to turn. So I would say that that's one of the sort of risk indicators that I'll be paying close attention to this year, because any signs of a turn there, and certainly there's other early warning indicators that we look at for US credit spreads, but this is a key one. And for now, it is giving a green light, and so we'll be on watch for any change in that. Number 6, this one shows actually another kind of similar one, is looking at the relative performance of cyclical sectors versus defensive sectors of the US equity market, and that's in the red line there. You can see that there's been really astonishing outperformance there. And you can see that that's actually, quite interestingly enough, lining up with the manufacturing PMI. And you'd expect to see that because as the names kind of suggest, cyclical stocks are going to do better when the economy is turning up. So it's sort of another confirmation of the improvement in the economy that we have been seeing. But on both counts, they kind of look about as good as it gets. So given the fact that it's actually this relative performance by cyclicals that has been driving the new bull market, it really is one that we need to be paying close attention to, because should those roll over, should cracks start to appear in the cyclicals, then that's going to be that could be the thing that does drive the much awaited or the much feared correction that has never came so far. So that one is it's another case of looking pretty good, but there's also some cause for concern in there, in that there is such a thing as being too good. So number 7 is, well, another very similar note to the previous few charts there. So this is looking at global average implied equity volatility, and this is looking at it across the major equity markets, and that's comparing it to the MSCI All Countries World Index. So it's a global equities benchmark. The key point there is that volatility has been at very low levels, and I guess there's a couple of open questions here for 2018. So it's one, will this sort of second great moderation that seems to be underway at the moment, will this continue, or will global equity volatility reach a turning point? And I guess the thing to think about on whether it may reach a turning point or not is, of course, what's happening with global monetary policy. The Fed is hiking rates and it's pulling back on, or moving into passive quantitative tightening. And, over in the Eurozone, Japan, they're nearing the end of their quantitative easing programs, and you've seen a couple of other banks around the world begin to at least stop cutting rates, if not start hiking rates. So the tides are certainly turning there. Whether it's 2018 is the moment that this starts to turn up, or the year after, that's one of the things that remains to be seen. And when you think about some of these indicators, it's quite clear that they give you a lot of direction and guidance, and but you kind of still have to play it as you see it rather than try to make some grand forecast. So I'll leave that one as an open question and certainly invite any comments on that. And one issue, if you think about it alongside these other ones, it's pretty important really, is so alongside the themes of a maturing business cycle and turning of the tides in global monetary policy, you've got a rising incidence of overvaluation across markets and assets. So this one's showing you the breadth of overvaluation across global equity markets. So the red line, the bright red line, is showing you the proportion of countries across the world that have their forward PE ratio one half standard deviation higher than average, and in the darker red line it's one full standard deviation higher than average. And you can see there that on both counts they're pretty similar levels to what we reached in the final stages just before the financial crisis, and also just before that correction in late 2015, early 2016. So, but they're not yet at the lofty heights that we saw in the early 90s and the late 90s. So that could be one sort of offset. I guess the other offset is the fact that yields are still very low, and of course that can change pretty quickly. But when you've got a situation of very low equity volatility, increasing incidence of overvaluation, the economic cycle looking about as good as it gets, and monetary policy, which I guess is flagged in this chart, telling, starting to turn. It's it's at the stage of the cycle where uh, you know equity markets can certainly continue to go onwards and upwards, but at this point it becomes more dangerous, I guess, is the key point. And that's why I've said back in the introduction here, whereas it is, yes, here we go. 2018 is going to be harder and more complex for investors than 2017. The cross currents of rising valuations across asset classes, maturing of the business cycle at a global level, and the turning of the tides in monetary policy could make 2018 a watershed year. And I've said this to a few people that this cycle, in terms of the economic cycle, the equity bull market cycle, it could continue for another couple of years yet. But we're certainly getting later in the cycle, and there's many metrics that I've showed you here that confirm that the cycle is steadily maturing. One, keeping with the global equity themes, one indicator that I will be continuing to update you on is this one here. It's the global equities breadth, the DEF watch. So it's the proportion of countries across 70 countries that we monitor that are experiencing what you call a DEF cross, which is when the 50-day moving average goes below the 200-day moving average. You can see there that during quite a few market corrections, or bear markets even, it started to turn up. You can see there that it had this sort of movement upwards towards the peak there. Of course, in a more sharper correction, it will spike, so it won't give you an early warning indicator. It will just tell you basically what's going on. But there is this habit for it to start to trend upwards into just before a correction, and there's a very good reason for that, because oftentimes corrections or bear markets, they don't happen for no reason. They happen because some sort of stress or risk factor is building up somewhere around the world, and that if it's and I often like to look at the details behind this, and I usually do that in the reports, because if you look at the countries that are comprising this, and there's a common theme there, then that can be a good risk flag, and that gives you sort of, I guess, the fundamental angle of this. Really, what is a technical indicator? So that has actually already started to turn up, and that's certainly something that we will be watching very closely in the weeks ahead. And last but certainly not least is China. And this here is a very useful chart that has served us very well. So in the blue line there, you've got monetary conditions, so that's combining a few factors such as real effective exchange rate, that's level and rate of change, loan growth, and real interest rates. And really what that one is showing you is the overall sort of settings and the change of settings of monetary conditions, monetary policy. And in the black line there is the fiscal impulse. That's just change the rate of change of the budget deficit as a percentage of GDP, and they're both standardized, these two indicators, to look at them on common terms. And you can see there that when in 2015-16 we actually had a bit of a growth scare in China, and my view is that they actually came quite close to recession at that point, because they had a number of cyclical and structural factors that were combining to really put the pressure on the economy there. And you can see there that obviously the authorities were not asleep at the wheel, and they noticed that, and they implemented a coordinated and very forceful fiscal and monetary stimulus program. And as those turned up there, that gave me the confidence to say that that was the low point, and certainly it was. And that this chart worked very well in picking the upturn in China, and of course that upturn there, not only did it take a bunch of risk off the table, so it made it easier to be very bullish on emerging market equities and global equities at around that time. It also made it very easy around that time to be bullish on things like copper and industrial metals. course, now that these have both rolled over and turned, um, it's much harder to be, you know, as bullish on emerging market equities or indeed commodities, or industrial commodities, the ones that are most sensitive to China. So, this, I guess, is probably one of the key ones to be thinking about this year, is both the fiscal impulse and the monetary conditions becoming at least less stimulatory, and if not, at some point will become a headwind. And so those are the 10 that really stick out to me as ones to watch. Of course, we'll be watching a lot more charts than that, and be providing, of course, the regular updates, both on the blog, but of course to clients as well. And just while we're on the website here, I may as well show you a couple of useful buttons here. So first one, the blue one there, is Twitter. We put some updates on Twitter. Also the LinkedIn company page, we put updates there. So be sure to follow YouTube. If you're watching this, you probably already know about that. We've also got a weekly digest, so be sure to put your email there, subscribe to that. And of course, if you want to learn more about the service, feel welcome to click through on the Become a Client tab. And of course, as I mentioned at the start, if you wanted to take a look at the full report of the 2017 end of year special edition, just download it on that page. And indeed, if you wanted to learn more, here goes the subscription inquiry form. So I'll leave it at that, and again, yes, Happy New Year, wishing you all the very best for a prosperous and healthy and happy 2018.